or expected, and whether the pandemic has been handled effectively or ineffectively by various nations is pretty irrelevant at this point in time. We're all in this. We're in it up to our necks. And really all we can do is look at how we can control to deal with the current situation as best we can, how to assess that, looking at the ways for our businesses to survive and until we have some sense of recovery. And then I guess the other part is what might recovery look like for one's business. And I think that's is very much a moving target today. The panel that we have assembled, however, is well equipped to discuss the process that I think we're looking at if you accept the kind of three phases. And I think phase one we're looking at, which is really immediate impact and short-term relief. We're in that right now. We'll talk about the programs that are available, who benefits, are they working, are they not working, are they falling short in certain areas? And I guess one of the questions we'll put to the panelists is that a lot of these programs are taking us through into June. Obvious question would be what happens after that. Survival mode is what everyone, and if you accept the programs are 90 days long, we've already burned 30 days. So from a business owner's perspective, you need to be working dramatically on what your survival program looks like. We're hoping to see some improvement soon, but practically speaking, even with that improvement, it's going to be a slow process. 2020 is going to be a disaster. The hopes are that 2021 will be more robust. So what are the specifics that owners need to look at to stay alive in this process, to stay on side with their obligations? And then I guess the last is, the recovery phase that we're looking at. As has changed in the last couple of weeks, the provinces are now rolling out some recovery plans. So that is, should start to give us a little visibility in terms of what we might be able to benchmark off of, and what that's going to look like as we try to ramp up from a dormant state. From my lens, we're still in phase one. Not looking to quote Mr. Churchill, but maybe we could say that we're nearing the end of the beginning. Let's see what our panelists have to say on these issues. Susie, if I can start with you, I think that you've been working very diligently, as president of the Hotel Association, and with your members. For the audience that may not be aware of, what can you give us a sort of the Coles Notes version of what HAC has been up to over the past couple of months?
Sure. One of the benefits of being one of the first hit industries and the hardest hit is that we had early numbers, early data, early analysis, and frankly, we were sounding the alarm bells for government first. And so that really did position us as a stakeholder that received early credibility and was somebody that the government turned to provide analysis and understanding of frankly the carnage in our sector and that the whole economy was headed towards. Our advocacy work has been in three key areas. One is employment, one is liquidity, and the third is recovery. Our lobbying has been highly supported by our members. We've had incredible engagement from our ownership community, large and small, and COVID response team that we set up, which is a subgroup of our board. We have been dealing at the highest levels of government, including the Prime Minister's office, Minister Joly, Minister Morneau. We are in touch with those offices on a daily basis, providing them with data, as I indicated earlier. But as these programs get announced and rolled out, we analyze them, and we do that really quickly, and we understand quickly what it means for the sector and where the gaps are, and we quickly make those recommendations back to government on how to course correct and fix some of those gaps. And they have been very responsive. I mean, all through this process, the government has said, look, we'll start here, we'll do more, and they have certainly been listening to us. What would normally take 12 months to develop in terms of a policy, like, a reform to the EI program, for example, would take 12, 18 months. They're doing it in 24 hours. And so they're really relying on the stakeholder community to be able to provide them with credible analysis. And that's really the role that we have been playing on behalf of the hotel sector. So we've hired a specialized team. We've got specialized tax, and economists, strategists, our own policy analysts in our office who are working, burning the midnight oil, working with officials and conducting these analyses. We've developed an extensive media strategy also to support this work. I think one of the early learnings from this process, for me and our team was that as much as we'd been hard hit, there is a perception that we are a big, an industry of big American chains that have deep pockets. And governments and also the general public don't understand that there are small and medium-sized owners all across this country who own the assets of those hotels, and it's not actually the brands that own those assets, not in most cases in any event. And so we've had to deal with those misconceptions because it frankly was hindering some of our policy work, and really repositioning ourselves as being a small and medium-sized business industry in a way that government and the general public could understand. And we've used our members extensively in that process. So many of our members have been on camera. There's been lots of, we've been on over 500 TV and radio shows over the course of this experience. We've also partnered with a number of like-minded groups. There is strength in numbers, so we've partnered with CHIC and Restaurants Canada and the Chamber of Commerce to be pushing some of our broader based policy recommendations, and certainly using our members to support the policy development and do some of that media work with us, and also use their own political connections. We've also been leveraging our provinces and our city hotel advocates, sharing our strategies and information, and making sure that our members are protected at all levels of government. This isn't just a federal solution. There are some very important policy considerations at the provincial and municipal levels as well. I would say that our efforts are working. We're certainly, I think, over-indexing in terms of our ability to influence some of these programs, and indeed we have, but there is a lot more work to do. A recovery is close, but really it's also far away. And we certainly won't stop until the sector's received as much support from government as possible.
That I think most people recognize that there's been a tremendous amount of work that's been undertaken. Could you speak to some of those programs? I think the federal government and various levels of government have responded quickly. I think that you might say that it was kind of a bazooka response in some of those programs, and there was a lot of work to be done to have them focus and make them accessible to the industry and to employees of the industry. Could you give us a rundown on the programs where we stand today?
Sure. So much of what's been announced, I think, in fact, all of it was in line with our early recommendations to government. But the devil's always in the details, and the government certainly is skewed towards supporting small and sometimes medium-sized businesses, but not necessarily large businesses, regardless of how hard hit they've been. And that, coupled with the thinking that we are big American chains with deep pockets, was something we had to overcome, and we did. So kind of the key programs that have been announced are, mortgage deferral, GST deferrals, income tax deferral until August. The wage subsidy program is probably one of the most critical pieces. It is, I would say, best in class compared to other nations. It's 75% coverage. It started as 10% for small businesses, and we were able to work with governments to push that up to 75%. And important there was that now they've put a qualifier in place. So you had to have 30% revenue reductions, and now even 15% revenue reductions in order to qualify for that fund. And so in essence, our entire sector is now covered by that policy. The CEBA loan program, so $40,000, 25% forgivable. We've been able to push them to broaden the criteria there. So now you can apply if you've had $1.5 million in revenue. And again, there's a forgivable portion. There's also larger credit facilities that are being rolled out as we speak. Very early days. Those programs, I think, are still under construction. But the BDC and the EDC, are going to be rolling out $300 billion, up to 6.25 per hotel. And so that those facilities are available. And then of course there's the CERB benefit for individuals who are off work and who need support. So there's the $2,000 a month as well.
Yeah, Susie, the wage subsidy program comes off the table in June, if I'm not mistaken. Is there any discussion going on or anything that you're aware of that is going to be extended?
Well, we are certainly pushing for that program to be extended. I think we're pushing for it to be extended until revenues, until we've seen that 30%, less than 30% drop in revenue, and that may take us 12 months down the line. So we're encouraging the government to apply the same sort of criteria that they applied at the beginning and sort of pull that into recovery. But we're even suggesting they should make it more focused and more targeted. So, maybe 70% revenue reduction, and then over time it's 50%, and then it's 30%, so that the money goes to the sectors and businesses that have been hardest hit. So that's absolutely a key piece of our future advocacy work. I think the deferrals are helpful, but they really do kick a problem further down the line. And ultimately, we need these liquidity programs to work so that the industry can access these funds. And we've got our work cut out for us on that particular program, the EDC and the BDC that's being rolled out through the banks. First there was talk of restricting it to, $6.25 million for your entire portfolio. So if you had 10 hotels, you had to spread it across. I think we've made some progress there. Early signs are that that's going to be applied on a property by property basis. Each hotel set up in its own corporation. But we need the program to be streamlined and simplified. We need there to be 100% loan backing guarantee for our sector. We need there to be no or very little interest, no bank fees. We need forgivable portions, and we need relief, not just debt. I think that's key here. We can't just, debt is not the answer. So there needs to be more relief, and that's certainly what we're pushing for. And in addition to that, there's a few other liquidity measures the government can look at, GST refunds, moving up the year end to now, and allowing some of those income tax refunds to come into play now. So there's a numbers of levers still at play here, but at the heart of it, we need to make sure that our members can access the liquidity and that they can get relief from it.
Ed, do you want to weigh in on that, the small and medium enterprise loan guarantee program that's coming through EDC and BDC and EDC, I think, right? Oh, you're still muted.
Okay, there you go.
There you go. Yeah.
Figuring out the technology. Sorry about that. Yeah, I mean, the EDC is the first program that kind of rolled out over last week. BDC is still probably several weeks away. There isn't necessarily some clarity around that. The EDC product, the way it's structured, it's very short-term initial funding of liquidity challenges. It is a debt product though, like to Susie's point, this is a structured secondary junior facility debt product, which has to be underwritten at the financial institution level. So to qualify, the institution has to first confirm that the borrower is in good standing, pre-COVID, good standing on covenants and performance, that the business is viable pre-COVID and is viable through COVID, through to the end of COVID. And most importantly, and this is where the caveat kind of makes the program a bit of a challenge, is that the financial institution has to underwrite to the fact that the borrower can repay the facilities that are extended within the prescribed term, which is initially 12 months. I mean, the program allows for a renewal and extension by another 12 months beyond the initial 12 months, but that requires a re-underwrite and a reapplication at the end of 30 days before the end of that term. So realistically, at the kind of the nature of the decline, the trough, and the recovery, which probably is not excessively clear currently, but what is clear is that that recovery is not within 12 months, and ability to repay those those debts within 12 months out of core operations is not realistic. So the institution is forced to underwrite to the broader business. So that kind of puts in question on accessibility, broad accessibility beyond the stronger, larger, owner operators, which kind of probably undermines what the government was trying to get to.
So work to be done there still. Lori, I mean, in the employment area, what are you seeing in the way of people adopting the programs or getting access, taking advantage of it? What's your experience been thus far in that area?
So anecdotally, the response from the business community and from my clients to the announcement of the wage program, the wage subsidy for 75%, has been extremely positive, and most expressed quite a bit of optimism that that would help them turn around. I should say that applications for the wage subsidy just opened yesterday. So we don't have yet a sense of how it's working functionally. Are people able to submit their applications? Are there hiccups and headaches in the way that there were when the CERB was rolled out? So I don't have that data yet, but certainly most of my clients expressed great optimism that the wage subsidy would allow them to start recalling people back to work, which is only good for the economy, of course.
Right. Just maybe sticking with that for a second, some of the specific questions that we've had and looking at seasonal businesses that don't have a winter revenue, but they're open in the summer. They're relying on deposits for the upcoming season. How do they take advantage of the wage subsidy program?
So the government has attempted, I think, to address some of these issues by giving you two potential reference periods when you're trying to show that you had a drop in revenue that would make you eligible for the wage subsidy. Either you can look at January, February of 2020 and say, versus where I was in that small period of time, and therefore I fall within the eligibility requirements, or you can pick a comparable period the year before. So if you're trying to show that you met the 15% eligibility in March of 2020, you can look at where you were with revenue in March of 2019. I think if you're unable to show a drop in revenue, if you're anticipating a drop in revenue but haven't yet shown those numbers, I think the government would say that you're not yet eligible, but to apply if and when you become so during the life of the program.
Okay, and then what about the, I guess just looking quickly at CERB, from an employer's perspective, how are you dealing with employees that are leaving to go on to CERB, and what kind of mitigation does an employer have in that situation?
Sorry, go ahead.
No, let's go ahead.
Yeah, I was surprised by how much of a temptation this appears to be to people who have safe work to do, to instead opt for the CERB, because although it's a generous government program, and I think Susie's quite right that most of our wage programs and benefits are best in class in terms of the comparisons to other countries, it very rarely replicates what an actual working person would be earning. And notably, it's taxable, so it's not in any sense free money. However, that being said, I do have clients who are reaching out to me and saying, I have employees who I believe are choosing not to work and trying to is a generous program, but it is not. Sorry, I'm receiving a notice that my audio is not working. Can you guys hear me?
You're back now. We lost you there for a minute.
Okay, great. I'll try and lean in and hopefully that helps a bit. David, stick your hand up if you still have trouble hearing me.
I will. Okay.
We'll deal with it then. Thanks. So In terms of managing that problem, there are a couple of challenges. Number one, the CERB is available to anyone who has to stop working as a result of COVID-19, if they're over 15 and they meet the lost income requirements. And what is defined as has to stop working due to COVID-19 is very broad and can encompass quite a few scenarios, self-isolation because of, okay. Do you want to move on and then come back to me?
Sure, we could do that.
Okay.
I think, yeah, it's just, I'm not sure what's causing the issue there.
Me neither. I apologize.
Yeah, and you know, we're now into this a couple of months. What have you been doing at Western Bank in dealing with your borrowers? What type of communication has been taking place, and what are you folks actually doing in terms of structuring, restructuring? What are you looking at currently?
We kind of started this process back in early March when kind of the rumblings of the impacts started to kind of take effect. I did a fairly substantial deep dive into our portfolio and presented to our executive risk committee and our board on figuring out where we're at in terms of our portfolio, to figure out how much capacity we had to extend facilities if needed, where we were and where we were going to end up through the trough, and so that we can kind of build some confidence around kind of the path of the business through the kind of the upcoming cycle, and also to initiate. We were first mover within the bank, and the bank was first mover within the Canadian sector, in the banking sector, to initiate the processes of extending deferrals and relief across their portfolios. So, and part of that was moving quickly to get in front of the board to figure out, to present the situation, and then build the process, a relatively streamlined process to get a lot of applications through and out for relief. I mean, it's not just turning off the machine. You have to go through quite a process and document that. So within a couple of weeks, we were able to speak to 98% of our clients within a couple of weeks. We were able to have direct one-on-one conversations with them relative to the current situation, and then extend the deferral and the relief. That was phase one. Phase two was digging a little bit deeper into our portfolios. Now I cover the hotel sector. I also cover the restaurant sector. So the restaurant sector, obviously, given the way less working capital versus the hotel sector, we're in more immediate, dire kind of working capital crisis needs, as they typically have very limited working capital and payables that run kind of a month behind. So through that process of analysis and discussion with the clients, that's where we focused in on establishing some liquidity facilities even before any of these. Obviously, the EDC program kind of started rolling out last week, so we were rolling out our liquidity facilities for targeted clients that were in immediate need, a month before that. Fortunately, the immediate needs from a capital perspective on the hotel side were limited at that point. Now we're getting through to that initial relief and deferral period. So we're heading into end of April, May, probably kind of reinvigorate those discussions to see where the cash flow crunch is within the portfolio. Fortunately, we came into this crisis reasonably leveraged and good coverage and a good mix of borrowers. So there is, to a certain extent, some capacity from a debt perspective and leverage perspective to address some of it. But the question is, is debt really the answer? Probably not.
Let's hold the next step or the next step in the process just for a minute. Greg, just wondering if you could step in there and tell us about some of the things that you've been up to. You're dealing with lenders, but you're also dealing with the other side of the equation. Maybe you can speak to us in terms of what some of the things that you're seeing, issues and concerns.
Sure. Thanks, David. Can everyone hear me, and can you see me okay? Because I've just had to move rooms in my house.
We can hear you just fine, but I can't see you anyway.
Okay. Well, my
yes,
camera's on,
you're
so
good.
hopefully folks can.
You're good. You're
okay.
Good.
Very good. Sorry. My apologies. This is sort of some of the interesting things we're all dealing with working from home. Sometimes you're in a room that apparently you're not supposed to be in. So I had to do a quick move there. Sorry about that, folks. Yeah, so thanks for that. I do work with lenders a lot in our practice, but I also work with borrowers and do a lot of work on the company side. Obviously at PwC, you have a large stable of audit clients. And so I've been spending quite a bit of time working with our audit channel clients and lenders as well. And I think, I guess a couple of kind of general comments I'd make that aren't necessarily specific to the hotel industry, but then we can kind of drill into it a little bit more. I think what we're seeing is there is an enormous amount of uncertainty. So, we talked earlier in this panel about government programs. I mean, the governments are dealing with enormous uncertainty. This is an unprecedented situation. No one's really been through this before, at least nobody really in a position that has to deal with this from a business perspective. I suppose there may be a few folks that had to go through the Spanish flu and back 100 years ago, but no one really understands this, and what the outcomes are going to mean. So we don't have a playbook. The governments don't have a playbook. Lenders don't have a playbook, and borrowers don't have a playbook. So I think I would say the first point I would make is I think everyone's trying to do their best without really a lot of information and tangible, measurable information. One of the things I think lenders that I talk to have consistently said is, we are here to be supportive of our borrowers. I think lenders realize that they are, they don't know what this means in terms of the kind of distress that they're going to see in their loan portfolios. They don't know how long the economic disruption or dislocation is going to last. And no one really knows what people call it a reopening, I guess, but it's a kind of a funny term I find, but the recovery, let's call it that. No one really knows what shape that's going to take, how long that's going to take, how responsive it's going to be. Things shut off pretty quickly. I would argue they're not going to turn on so quickly, but obviously we'll get into that hopefully a little bit later and have a bit of a debate about that. I would say that lenders have generally been, again, very open to being supportive of their borrowers. I'm personally working for a couple borrowers right now. We are engaged in negotiations with their lending syndicates. We are seeing things like covenant relief being very accommodative on covenant relief. We're seeing some restructurings when it comes to term loan payment obligations, deferrals, particularly of principal payments, seem to be a fairly popular tool that are being used, that's being used right now. I think from a borrower's perspective, if I was to give someone advice, I would just say, put yourself in your lender's shoes. If you're going to ask your lender for accommodations, support, etc., understand that the relationship person that you're dealing with on a day-to-day basis is not likely to be the person that's going to make credit adjudication decisions. And I encourage the borrowers that I work with to be proactive and to be transparent. And those are the two things that I really try to always talk to about our borrower clients is, don't be afraid of your lender. It does not necessarily means that your lender is going to support you. Lenders are obviously have to deal with their own stakeholders, and they're not going to just write a blank check. I don't think that's the case at all. But I think that the lenders are willing to listen and willing to be accommodative if you are proactive, if you're transparent, and if you come to them with a rational ask. So those are sort of some high-level comments I'd make at the start here, David.
Okay, no, that's fair enough. So at that point, we've had the relief, and I guess I throw this back to both Greg and Ed. And Ed, we're really looking at a business plan for, I think you're looking for a business plan from your borrower in terms of how they're going to manage this process go forward. What kind of time frame are you looking at? And I guess Greg would be the same question. You can both comment on that. What kind of time frame are you looking for, and how detailed are we looking at in that business plan for the borrowers?
Well, I wouldn't say necessarily it's a full-blown detailed business plan, but just a good awareness of where they were kind of going into this, and then kind of the monthly walk over the next 18 to 24 months, which is the kind of the realistic kind of time frame of the decline, trough, and recovery. What's being done through the P&L to address some of the kind of the operating top line erosion. You know, where are you looking for deferrals, whether it be tax, et cetera. So, and walk through, I mean, we're not, also the ability to kind of give some sense of how to position after 2 years, because I mean, lenders, at least us, we're looking at trying to figure out what a normalized decline and recovery would look like from a valuation perspective, and then also evaluate the cash crunch over the first couple of years in that time frame to be able to kind of structure against it. And then some of the mitigating demand level activities by the borrower, whether it be, you know, seeking out bulk rental contracts with municipalities, healthcare, et cetera. There's been quite a bit of creativity among the borrowing groups. So we'd be kind of looking towards that, and then addressing some of the kind of the risk factors of shifting demand sources. You know, what's the impact on your franchise agreement? What's your impact on your insurance? What's your impact on the physical asset of it? How are you mitigating that? So it's those elements. It's figuring out what your cash flow drain is over the next couple of years, figuring out how you position your asset within your market set, and what that looks like, you know, 3, 4, 5 years from now, so that you can you have to have a dialogue with your lender on expected, reasonable, normalized value, and what debt capacity is reasonable within that, and work towards a structure that includes kind of a debt service reserve within that structure to be able to kind of facilitate kind of the medium to longer term period.
So short-term survival, and looking at how do I survive in the short run? What type of accommodation can I get? And looking at a 2 to possibly 3 year period in getting back. But are you getting back to a pre-COVID level, or are you getting back to a level that you are sustainable without a lot of accommodation from supporting sources?
Well, I think what we're spreading to, what we're performing to, is 18 to 24 month decline to recovery to somewhere in the 75 to maximum 80% of pre-COVID levels in terms of performance. Obviously, there's a lot of factors that are going to play into that, and there's regional economics that are going to either make it better, make it worse. You know, if you're in Alberta with what's going on with oil, that's probably going to be a bit longer, a little bit deeper. So support there is going to be a bit more challenged. And then it's just the way that owners are going to react with each other when it comes to when demand does start kind of ramping back up, and the impact on rate, because I mean, everybody knows that the biggest damagers of profitability is one, supply, which hopefully, well, not hopefully, it will dry up. Maybe not the projects that are in the ground currently, they'll kind of hit the supply over the next year or two, but in 3-4 years, supply is probably going to be very muted, which is positive. But the second is a war on rates, right? Like trying to grab a bigger piece of the pie. You're not going to be necessarily driving demand, but as long as owners can kind of manage within their market sets the erosion of rate, that will also be a pretty important factor on profitability.
Okay, Greg, any thoughts there?
Thanks, David. Yeah, I mean, there's a lot there. I agree with Ed in when he says cash flow. I mean, I think that I don't think that your lenders are going to be looking for what you would maybe historically have characterized as a formal business plan. Quite frankly, I'm not sure how you would do that. I think the ability to forecast right now is setting aside the actual act of building a model, which is one thing. The ability to settle on an assumption or a scenario, I think, is very, very challenging. Is there recovery responsive? Is this V-shaped? Is it U-shaped? Is it L-shaped? Is it something else? So what I would say is I think that borrowers should be building financial models that focus A, on cash flow, and B, allow them to do some sensitivity analysis, some what if scenarios to try to understand the impact on them and their business and their cash requirements of a variety of outcomes, none of which you can actually determine right now, and it will only be determined with the passage of time. And so I think what you need to be able to do is be flexible, make sure that you're forecasting your short-term cash flows. You should be doing it, I would suggest, on a weekly basis, at least for the first 3 months, and then monthly thereafter. Really, this is the name of the game here is going to be, who can manage cash the best. That is the king of all resources right now, is liquidity. And this is, in my view, this is an issue of, can you get to the finish line, wherever that finish line is? Or maybe said another way, can you get to the new starting line?
Okay, thank you. Lori, see if we can get your, I just want to jump back on something that we had some questions coming in. And one of the questions was, how do you use temporary layoffs effectively, and how do you manage recalls? And can employees who are laid off claim wrongful dismissal? And how long can a layoff last?
Sure. So I'm going to stop my video in the hopes that it improves my audio quality.
Sure.
Okay. So the first thing to keep in mind with layoffs is that for many employers, you don't actually have the right contractually to lay people off. There are exceptions for most employers who have collective agreements in place. So if you have a unionized workplace, it is very likely that your
agreement contemplates a layoff procedure. So you should review that to see what your rights may be. Absent a collective agreement and absent a contract that specifically contemplates it, if you lay someone off without pay, you could be liable for a wrongful dismissal claim, because that would be deemed to be a breach of the employment agreement. I will say that most, if not all, of my employer clients are using layoffs, regardless of whether they have a contractual right. They're managing that by doing a couple of things. Number one, by communicating regularly with the employees on layoff, making sure that they understand that this is part of a larger business strategy. It's not an attempt to avoid or defer rights that they otherwise have. They're truly trying to save the person's job and the business itself. So they're counting on employee buy-in for that, and that helps manage the risk that someone's going to say, you've breached my contract, I'm going to a lawyer. The second thing that they're doing is they're exploring whether or not they can put these employees on a work share program, which allows for some employees to earn income while they are job sharing. It's a difficult program to satisfy the requirements of, but it is something that's worth exploring if you have a suitable workplace. In terms of managing recall rights and the process of recalling people, it varies by province, and it will vary if you have a collective agreement, which may specifically state what you have to do to recall employees, how much notice you have to give. But generally speaking, you issue a notice of recall, and the employee then has a reasonable period of time, or a specified one, 24, to report for work. And if they don't do so, they are deemed to have resigned from their employment, and you would issue a record of employment confirming that.
Okay, so they have some rules there. Okay, so I wanted to jump in on that one because and I think previously when you were in the process of answering the question on if whether people could still collect EI and CRB at the same time. Can they work reduced hours and still collect EI? I think was where you were, one of the questions you were on. You can respond to that now, possibly.
Right, so there are a couple of options for that. I alluded to it earlier when I talked about how people are managing layoffs. Number one, you can participate in an approved employment insurance job share program, and that does allow for people who are working part-time, they're sharing jobs, to get some payments of EI. That, as I said, that does have some procedural hurdles. It's not a quick turnaround, although Service Canada has said they're doing their best to process these on an expedited basis. However, if you have employees who aren't working as much as they used to, and you only have a little bit of work available for them, they may still qualify for the CERB. The CERB is available to anyone who's earned, any otherwise eligible person who's earned $1,000 or less for 14 consecutive days. So there is the possibility that people who have some work to do but nowhere near their full-time capacity can.
Sorry, we got an issue on that again. Try that again, Lori, please.
Sorry, guys. I really apologize for this. It was working perfectly for my cocktail hour last night. I don't understand why it's now not functioning. But for the CERB, there is a possibility that employees can do some work and still receive the CERB benefit. The requirement is that they earn $1,000 or less for 14 consecutive days. So having some income and some work available to you won't necessarily completely disqualify you.
Okay, fair enough. Thank you. I wanted to come back to you on that because we cut you off earlier. I wanted to come back to Ed and Greg though on this whole issue on what the recovery looks like. Ed, is it fair to say that in the short run, it's not really a value and loan to value issue from a lender's perspective? I mean, back to Greg's comment, that the communication transparency has to be there. But what we're really dealing with over that 18 to 24 month period is cash flow more so than the value component and the LTV.
Yeah, definitely. I mean, the immediate concern, I would say today's concern looking forward for the next 12 to 18 months is cash flow, understanding what that cash flow looks like, understanding what is being done through the P&L to kind of mitigate the top line erosion, what is being done to change kind of mix of revenue. There, eventually, I would say quicker than one would expect. I mean, I think when the dust does start settling, as the regulators kind of go through our portfolios and our exposures, it will eventually, or quicker than not, lead into a discussion on leverages, right? Exposures, and that does end up becoming a discussion on value. You know, where were you before? Where do you expect to be through the first couple of years? Like when you exit, I mean, you have, as a financial institution managing a portfolio of assets and exposure, you have to, in a disciplined manner, be able to communicate that, to document that, and to manage the potential impacts of impairments. And impairments are driven by both, obviously, borrower behavior and ability to either pay or restructure, et cetera. It's also about being able to identify how and where you're over leveraged and need more capital against the particular exposure. So,
are you talking about borrower impairment or the lender being impaired?
Lender, well, it kind of starts with the lender being impaired. I mean, it's the chicken and the egg. It could start with the borrower not paying, or there's no line of sight to some form of payment over a certain amount of time. It's oversight on leverage. I mean, if you're going in at pre-COVID, you're going in at a very high leverage at peak value. I mean, we were sitting at the most liquid time in the history of this industry. There were more lenders, the values were, performance were at peaks, cap rates were at troughs. So if you're sitting and you've leveraged at the peak of that market, then there's going to be a very different discussion and very, very different impairment impacts over the next year or so versus better leverage portfolios.
So then the next question, Greg, if we have lenders that are being impaired, you got and borrowers that are at that level, where all the programs are throwing debt at the problem. The next answer is got to be some other form of debt or equity, I would assume. And where's that?
Yeah, well,
equity
Susie
going?
mentioned it. Yeah, sorry, David, I didn't mean to interrupt. Sorry,
No,
I thought you were done. Pardon me.
No, fine, go ahead.
Yeah, Susie really touched on this at the very start. One of the first questions you asked her, when talking about sort of, more debt isn't the answer. I mean, I actually said to one of my colleagues about 6 weeks ago, when the first day we kind of got sent home, middle of March, and I said, look, we're getting a lot of stimulus is being announced. We're going to see a lot of requests on lenders to not just give covenant relief and payment holidays, but eventually this is going to become, can you lend me more money? And that's going to be the next question. And I just said, we're in an issue here where a health crisis is creating a liquidity crisis, and the liquidity crisis, if it's solved in the short term with more debt, with more leverage, then what we're really doing is sowing the seeds for tomorrow's insolvencies and restructurings. Now, that said, if there's no other choice, there's no other choice in the short term. So I agree with you. It's interesting. You can't just create equity out of thin air, though, right? I mean, we have to sort of think about, where does equity come from? So obviously, if you're owning an asset, and you might start to think about, does it make, are there synergistic benefits in a distress scenario for sort of distress M&A transactions to increase? So in other words, is there a way to spread my fixed costs? And I appreciate in this industry, I think the opportunities are less so in this industry, unfortunately, because most of the costs are contained within the building itself. But I do think we'll see some creative business combinations. I think we might see some opportunistic acquisitions. I think we're going to see a lot of assets go up for sale. I think we're going to see some assets change hands as people try to find ways to figure out which assets are the ones to bet on, in the future, which hotels are going to be the more higher in demand than others, which Ed touched on it earlier when he talked about Alberta. Saskatchewan would also apply from an energy perspective. Which regions are going to be more under duress, and for how long? And does that then also impact your capital allocation decision? Are you better off to say, I've got scarce resources, I can save certain assets because I think there's a better chance of success, but others I may just have to hope for the best on. So I mean, I think it's a great question. I wish I had an answer I could tell everybody on the call, but I don't. I mean, I do think that I've given you a couple of examples of things I think we're going to see happen.
Yeah.
But I do agree with you that the more leverage we put on any asset, whether it's another hotel, it's a hotel or otherwise, and to Ed's point, when the loan to value ratios are going to go pear-shaped, things are going to go upside down. Valuations have to be coming down, given there's no occupancy right now. It's obvious. So I do think we're going to have a lot of distressed transactions happening in the very near term.
Yeah, I think I first met Ed, I think, in 1997. And in 97, the hotel industry in Canada was starting to open up again after the 90-91 recession, which was, most people today are referencing SARS, 9/11, the GFC. 1990, 1991 was a very different scenario. I think lenders basically capitulated at that point in time. I think if we look at what's happened in Alberta in the last 5 years, we're looking at a different behavior. But there is ultimately there is an end to the length of that piece of string. And as we start to look for additional equity coming into the market, then some of the options that you mentioned are probably going to be there. We have ignored Susie and Lori for a long time in this conversation. I think we could probably do 4 different panels. Susie, having listened to all of this as we're going on, are there any points that you would like to jump in on? I think I guess the issue on recovery is we don't really know, but in working with the government, I'm assuming there's going to be regulations and different regulations that are going to have to be dealt with and we get back into reopening our recovery. Any thoughts on that?
Yeah, first of all, yes, the industry needs relief. There's no question about that. And that is a key piece that we're working on. Not only are we trying to get access to the, streamlining the application process to this big credit facilities that's coming through BDC and EDC, but getting decent terms in place and getting a portion of those funds to be forgivable. And the criteria that we're recommending to government on that is that they use amounts paid on fixed costs like mortgages, like property tax. I saw there's a few questions there about property tax, that those would be forgivable if the funds were used on that basis. So we are going after relief and other forms of liquidity as part of this sort of immediate area of focus. But as we look ahead into the future and what does recovery look like, I think there's a few issues here. First of all, I do think we'll see some form of recovery package from the government. I think they will invest in stimulating our sector, and we know what those levers are because we've used them in the past in a number of different scenarios, SARS, the 2008 financial crisis, etc. But this one's a bit different. I think we know that eventually we'll see, in the long term, once we start to get into mass gatherings again, we'll start to see some stimulus for groups and convention business and incentive travel pieces. Obviously, marketing is going to be part of the equation. First domestic and then international once we start to see some of these travel bans lifted, etc. But there is another immediate term kind of gray zone that I think we're all living in, which is it's 18 months, if not longer, for a vaccine. And so people are going to be leaving their homes, and we can assume that they'll be traveling. But there is a consumer confidence piece that will need to be addressed. And I think the brands are very busy, and our independent hotels as well, in trying to figure out what does that look like. What are the cleaning protocols that you need to put in place in order to build up that consumer safety? Do you need a third party coming in there and certifying that that's what you say it is? And to what extent is that going to play into people's willingness to want to travel? And then where does the government come into play? So they're going to be issuing guidelines all over the place in every different province as they open up certain segments. And where do those guidelines in terms of public policy hit the road in terms of operationalizing those programs? And some of the things we're thinking about now is, who should pay for it? So if we have hotels that are putting up plexiglass or, testing when people walk into a hotel, are those hard costs borne by the hotel? Are they borne by the government? If the government is going to be prescriptive about what this looks like in terms of you have to meet a certain, criterion in order to reopen, who picks up that cost at a time when the industry is already cash strapped and, really teetering on a sort of a life and death circumstance for many of our owners out there. So I think the recovery is going to be very much a phased approach in the same way that the reopening of the economy is a phased approach. But there is that wild card where I think the new normal, until we get a vaccine, that new normal is going to look different, I think, for all businesses.
Lori, just wondering if there are any points that you would like to. We've got about 4 minutes left. If you'd like to jump in on any points that we haven't. I know there are many points that we haven't touched on, but some issues that you or suggestions you could leave with us.
Sure. So I will add a layer to what Susie mentioned about the new normal, which is not only is there consumer confidence in terms of establishing a safe place for people to come in and visit and stay, there will be workplace safety layers to that as well. So we haven't yet, but may still see new regulations from our provincial governments regarding what workers are entitled to in terms of a safe workplace. Things I would keep an eye on is there may be regulations regarding how much personal working space they're permitted, sanitization opportunities, hand washing stations, and that may be heightened for people who have to or are required to interact with things like soiled linens, actually having to make personal contact with guests in a hotel environment. So those are things to keep an eye on for sure.
Okay. Ed, any final comments?
Well, I think from the perspective that most downturns involve a relatively orderly kind of deleveraging, and changing out of financial players and partners, et cetera. We've seen that consistently through cycles. What's particular with this one is the velocity of it and the precipice from which it's coming off of, peak liquidity. We expect contraction of appetite as well as profitability. That being said, I think what's unique, the financial crisis of 08 caused the financial system to be better kind of buffered. So what has not gone down is the liquidity in the financial sector. So systemically, the financial sector is working. Now we're having a demand shock. The governments figured it out through the financial crisis that they needed to move fairly rapidly. I mean, it's a very complex thing to move a government and bureaucrats. To Susie's point, they're getting stuff done in 24 hours, which would typically take months and months and months. So there's clearly a gap. There will be a gap. It's a question of surviving the near term. There's a ton of creativity in the sector, way more sophistication than there was in the early 90s following that decline. Interest rates will continue to be low. I think government support will catch up. I think it's trying to get to that orderly deleveraging, which I think will come over the next 18 to 24 months.
Okay. Yeah, good point. Greg, any last comments?
Communication's key. Be transparent, be proactive, and get on top of those cash flows. I think that's the key.
Thank you. Appreciate it. We're at the top of the hour. I just wanted to leave everyone with one thought. Dr. Jim Heppel has written a paper on the possibilities of the recovery for the tourism industry in Aruba. The only reason I reference that is that he points out that when will this end is not the right question. The right question is how do we continue in a COVID-19 world and how do we manage through this process? When the only magic bullet right now is a vaccine. Until we get there, we're going to have to live and work within this environment.
Thank you, David, Susie, Greg, Lori, and Ed. We hope you enjoyed today's webinar. Stay tuned for our next CHIC Digital webinar on this series, addressing all of your questions and answers, which will launch in May. And we are also pleased to be announcing another series within CHIC Digital, which will be on hotel best practices in the reopening process of your hotel assets. So watch for that coming mid-May. Thanks, everybody, and have a great day.
Thank you.
Thanks very much.
Thanks.